everybody these days is coming in and saying, Nick, this is different. Or they'll talk to any of our advisors and say, this time's different. We've never dealt with this in our world. What's going on? What do we need to do? And, in some ways it's different. In other ways, we've seen this before, and people have been saying these things for 90 years. So what we want to do today is just give you a sense of calm and not necessarily say that everything is going to be perfect, but that everything can be okay. The way I like to talk about investing and just kind of the ups and downs and all arounds and how you handle it is a roller coaster. And it's funny, my wife and I just took our kids to the Mall of America. We like to do experiences for their Christmas gifts and things like that. So this year we took them to Mall of America and Great Wolf Lodge, and you start at Mall of America, and it was funny, I'm sitting on these roller coasters, trying to hold in my lunch. And you think about it, it's like, it is exactly what we're dealing with in the market right now. It's this up, you fly down, you're back up, then you're down, you're all around. And it seems like that's exactly what we're dealing with in the market these times. But you look at it and we get done with the roller coaster, and our kids don't think twice about it. They don't think about the ups, downs, all arounds. They think of the joy and the benefit, I guess if you want to call it that they got out of the ups and the downs and the all arounds, and they run back in and they get back in line and they want to do it all over again. The ones that don't get to experience the fun are the ones that are on the sideline, and the ones that are sitting there waiting and are too afraid of the ups or the downs that they don't get to experience any of it. People that ask a lot if this is different, is this the same as what it's been before? And it's hard to predict the future. I would say that's the one benefit of where a lot of us around here would have a faith that says we know who holds the future, which gives me a lot of peace just in all of where our country is and where things are at. I know there's a lot going on in our world with obviously the continued pandemic, and you get all the anxiety that people have with inflation, and there's a lot going on in the world. So we fully acknowledge that and don't want to discount that there are important things going on in the world. But when you break it down and you look at it in terms of how we do our investing, I think we have some recency bias, and people look at a year like 2019, even what 2020 became. Yes, we had the early 2020 with the dip, but it came back so fast that you look back now and nobody even really remembers the dip of 2020 because they just look at their returns for that year and think, well, we've just been on this huge upswing, in the market, and we shouldn't have volatility. We shouldn't be experiencing the losses that we're experiencing now. And what we try to convey to people is that what we're experiencing now is normal. If you look at take one of the indexes, take the S&P 500, the average return over 90 years that the S&P 500 has provided. If you put your money in and let it sit, the average return is somewhere like the 8.2% range that the S&P 500 has returned on average. So people look at that, and I think mentally we have a way of thinking, okay, well, that must mean that it was 9 one year and 7 the next, and then 8 the next, and then 10, and then 6, and we kind of play the numbers in our heads like that. Well, if you actually look at the historical returns of the S&P 500, you're going to find years where it was up 37, and it was down 28, and it was up 42, and it was down 32. You're going to find numbers that are all over the board. And in order to average out that 8% return, you've got to be willing to stay, and you've got to be willing to deal with it. So the problem with the timing is that you got to get it right twice. It's not just, hey, we're experiencing market highs now, let's get out and let's avoid, what's to come, because there's nothing that guarantees that the market, one, doesn't continue to go high. The second part of that is when the market starts to tail, like it has done recently, one, you've already experienced losses when all of a sudden your stomach starts to churn a little bit and you start to say, okay, I think it might be time to get out. Well, the problem is you've already experienced some loss. And so now if you can completely get out of the market and you're sitting in cash, you just locked in those losses. And so that's problem number one, is that we just locked in loss. Problem number two now is everybody thinks that they're going to be able to predict the bottom and know exactly when to get back in. Experience would tell me that people aren't willing to get back in until they've already start to see things come back on the upside, and you've missed some of those first big days of recovery. And so you've experienced the big days of loss, you've missed the big days of recovery, and what you've done is you've hampered your portfolio for the long term. Because unless you can time it perfectly and sell right at the top and then get back in right at the bottom, the best course of action is generally going to be to leave the money in and let it work and be able to deal with the ups and downs and all arounds that this roller coaster ride of investing is gonna provide. So that's the message that we want to try to convey to people. Now, there's a couple things in there, that we want to emphasize as well, and that really goes back to the fundamentals that we talk about in a lot of things. Is one, timing the market is an extremely difficult task, and like I just referenced, if you're not going to get it right on the top and the bottom, it makes more sense to let the money work for you. Now, the other thing that you have to focus on, though, and we talk about it a lot, is risk tolerance, right? So we're assuming that the portfolio that's been crafted and created for you. And so we have people, when they come in, do a risk tolerance questionnaire, and we talk a lot about risk tolerance and risk capacity. One is what can you stomach, and two is what can your portfolio take on. That's what risk capacity is. Well, in times like this, we really get a good indication into what people can stomach. So we'll get calls and they'll say, geez, I'm feeling sick looking at my portfolio. I can't believe that it's fallen this much. And we look back at their risk tolerance and it's only fallen a fraction of what they feel like they told us they could tolerate. And so to have them redo a risk tolerance in a time like this is important. The hard part gets to be it's this trade-off, right? Nobody wants to see their portfolio fall, but everybody wants to see it, shoot over the moon when things are going well. So everybody wants, peak returns when things are going well, and nobody wants any losses. So using times like this to reevaluate risk tolerance is really important. Two, I would say always going back to the financial plan. We've always been goals-based planners. That's what we talk through. Do you honestly need 30% returns every year to accomplish the goals that you're trying to accomplish? No, probably not. What we like to do is break it down to the standpoint where you could say, this is your goal, and here's the return that you really need to get in order to accomplish that goal. Now let's manage to that goal. And that's what we always want to point back to, is when we run financial plans for people, we account for all of this. We account for the volatility. We never assume that the market is always going to be going up every single year. We account for years just like we're experiencing right now. So what we try to do is point everybody back to their plan and say, you are still on track for everything that we've discussed. This is not at all moving you away from your goals. This isn't altering how early you can retire. We always want to be able to point back and do that. Third, always staying true to your plan and the consistency in what we're doing. So when we talk through the plan and we say, hey, we need to start consistently saving, into these accounts, as we do that, we're accounting for putting some into the market at market highs. We're accounting for putting some into the market at market lows. And this whole idea of dollar cost averaging in. And so staying consistent and true to the plan that's in place, continuing to save, is important if feasible, but sticking to a plan and doing it consistently is an important piece of getting through these times and knowing that it's not going to be easy, but it's going to be okay. I believe in the companies that are a part of these portfolios. I believe that our economy can be strong. I believe that consistently staying in the market and being in the stock market can prove to be beneficial for people's portfolio. And I think the roller coaster ride can be wild at times. But like it was with my kids, I look back and I don't remember the sick feeling, that I had when I got off the roller coaster. I look back and I remember the smiles on their faces. I remember the joy that it brought us, and it gave us a memory and an experience together. It's the same thing in investing. When you look back over a 30-year or 90-year period, you're not going to remember the rough start to 2022. You're not going to remember the big dip of 2020. What you're going to remember, you may remember those, but you're going to look back and what you're going to see is the long-term benefit of having held fast and done what we believe to be important in staying true to the plan that you have in place.